Welcome back, investors, to Ticker Time News. I'm Adam, and today we're talking about the Consumer Price Index, the CPI. We're going to get into the details of the numbers, which should only take a few minutes. And then we're going to answer a few questions. What can the CPI actually tell us? Who uses the CPI, or what can you use the CPI for? Why is it important for investors to know? And what does it mean for our purchasing power? More importantly, how can it affect certain stocks, potentially growth stocks? We're going to answer all of these questions in this video and more. So make sure you stay tuned till the end to get all of the information. So before we get into the actual details of the report, I just want to give a quick explainer to why we are even interested in this data in the first place. So, the first question that comes to mind is, what is CPI data used for? So, to answer that in a summarized way, CPI data is one of the most frequently used statistics for identifying periods of inflation and deflation. As prices for goods and services increases or decreases, for example, when you go to the grocery store, do do groceries cost more or less? When you fill up your vehicle with gasoline, does that cost more or less? When you hire someone to cut your lawn, does that cost more than it did last season? CPI data, it's a means of adjusting dollar values. The CPI is often used to adjust consumers' income payments, like Social Security, for example, to adjust income eligibility levels for government assistance, and to automatically provide cost of living wage adjustments to millions of American workers. So, why are we monitoring the CPI data more closely now than in prior months? Well, investors, the Federal Reserve, and businesses continuously monitor and worry about the level of inflation. Inflation, the rise in the price of goods and services, reduces the purchasing power each unit of currency can buy. Rising inflation also has an insidious effect. Input prices are higher. Consumers can purchase fewer goods. Revenues and profits decline, and the economy slows down for a time until a measure of economic equilibrium is reached. Since inflation is expected to rise over the coming months, say May and June, as investors, we need to pay close attention to how quickly inflation is rising. This will affect growth stocks the most because higher inflation will make financing growth more expensive and reduce the value of future cash flow. Remember, inflation lowers the value of the dollar. It lowers your purchasing power. The Consumer Price Index, or CPI, increased 0.06% in March on a seasonally adjusted basis after rising 0.4% in February. The March 1 month increase was the largest rise since a 0.6% increase in August of 2012. Over the last 12 months, the all items index increased 2.6% before seasonally adjusted. The gasoline index continued to increase, rising 9.1% in March and accounting for nearly half of the seasonally adjusted increase in the all items index. Natural gas also rose. Food index rose 0.1% in March. Food at home index and the food away from home index also both rise 0.1%. So, out in the real world, food overall rose 0.1%, whether that's going to the grocery store buying food or going to a restaurant and buying food. The big spike was in filling up your gas tank. That rose 9.1%. That's a big rise. That means the price that you pay per gallon to fill up your vehicle has jumped 9.1%. It's jumped a lot. And that was the biggest jump from February to March was gasoline prices. It goes on to say that the index for all items, less food and energy, rose 0.3% in March. Indexes which decreased over the month included apparel and education. The all items index rose 2.6% for the 12 months, which ended March, a much larger increase than the 1.7% reported for the period ending in February. So in February, it was 1.7%. In March, it was 2.6%. We could see it in the 3, maybe as high as 4% for next month, May, and also in June. But then we get to July, it should start to come back down some. Now, the reason being is because when you think about last year, during the heaviest parts of the pandemic, almost everything was shut down during May, June. So that's why the percentage should go even higher for next month and the month after that for the next 2 months because it was the heat of the pandemic at that time and a lot of things were closed. The index for all items less food and energy rose 1.6% over the last 12 months after increasing 1.3% over the 12-month period ending in February. The food index rose 3.5% over the last 12 months, while the energy index increased 13.2% over that same period, over the last 12 months for the last year. So those numbers are all annualized. Month to month, we went up 0.6%. If you annualize that, for the year, then it would have rose 2.6%. And that was really close to what was expected to happen. And again, next month it should be in the threes, maybe as high as 4, but probably 3.5 ish. And then June, maybe we'll get a 3.8, 3.9, or maybe even the low fours. So we'll have to see, but we're definitely expecting it to go up. Now, next in this report, they show all your data points instead of in word form. It's just listing everything out here with their individual percentages and the last 6 months individually. So you see the very top that I have highlighted. It's all items for March 2021. It rose 0.6%, and on an annualized rate, that was 2.6%. And then it goes down and it breaks everything out by category, like food, energy, and then it dives in a little deeper if you want to understand those individual categories that they have. I'll link this document in the description below so you can actually go in if you want to and look at the details for each section, or maybe a section that you're curious about. And then you get down to the bottom, and then it explains to you how things are measured, what's measured, how they do the calculations. If you haven't read it before, it's it's a good you should set some time aside and go through it and read it. It takes a little while to read it. You might have to go through a few sections a couple of times to really understand what you're reading because they throw a lot of information at you. But to get the base understanding of what the CPI is the consumer price index measures the change in prices paid by consumers for goods and services. The CPI reflects spending patterns for each of two population groups: all urban consumers as one group, and the second group, urban wage earners and clerical workers. The all urban consumer group represents about 93% of the total US population. That's why they're only measuring two groups, because it accounts for over 93% of the population. Not included in the CPI data are the spending patterns of people living in rural, non metropolitan areas, farming families, people in the armed forces, and those in institutions such as prisons or mental hospitals. So, in a nutshell, what this means is your dollar, your purchasing power decreased by 0.6% over the last month. And if you annualize that out, your purchasing power decreased by 2.6%. Now, it does seem like a small rise from month to month, but it was the largest month over month rise since August of 2012. So it's been a while since we've seen a rise like that. And again, we are expecting May and June to rise even further. So I hope you found this informative. If you did, please smash that like button and click subscribe and join our family of investors. I'll see you in the next video. You can help out the channel and earn free money while doing it. First, earn $10 worth of Bitcoin by signing up for a BlockFi interest account and depositing $100. Plus, the added benefit to using BlockFi is that you will earn interest of up to 8.6% annually on your cryptocurrency. Second, earn 2 free stocks worth up to $1,850 by signing up to Webull and depositing $100. Click the links below to get started.